Welcome to the final content section of PNJ Group's ASC 805 Business Combinations Training. We've built the full picture of the acquisition method. Now we cover what happens in the financial statements after the deal is done, the disclosure requirements, how US GAAP compares to IFRS 3, the mistakes that appear most often in practice, what auditors expect to see, the controls and roles involved, and a period-end checklist you can use in real engagements. By the end of this section, you'll be able to identify all required disclosures for a significant acquisition, both in the period of acquisition and in subsequent periods. You'll distinguish the meaningful differences between a SC 805 and IFRS 3. You'll recognize the most common errors that arise in business combination accounting. You'll describe the specific areas auditors focus on and what documentation they expect. And you'll apply the period-end checklist to ensure no step has been missed in a live acquisition engagement. A SC 805 requires extensive disclosures for significant acquisitions in both the period of acquisition and subsequent periods. In the period of acquisition, you must disclose the acquiree's name, description, acquisition date, and the percentage of voting equity acquired. You explain why the combination was pursued and how control was obtained. You provide the fair value of total consideration transferred broken down by component, cash, shares, contingent consideration, other. You list the fair values of major identifiable asset and liability categories. And you provide goodwill detail, the amount recognized, the factors that make up goodwill, synergies, assembled workforce, market position, and whether any of the goodwill is expected to be tax deductible. Additional disclosures cover three important areas. First, the non-controlling interest, its measurement basis, and the amount recognized. Second, financial performance, the revenue and earnings of the combined entity since the acquisition date, and pro forma revenue and earnings as if the acquisition had occurred at the start of the fiscal year. These pro forma disclosures help investors understand the full-year impact. Third, contingent consideration, a description of the arrangement, the range of possible outcomes, the fair value recognized, and the basis for estimating it. And in subsequent periods, any measurement period adjustments must be disclosed, identifying the nature of the adjustment and what changed from the provisional amounts. ASC 805 and IFRS 3 were developed jointly by FASB and IASB, so they are highly converged. Both require the acquisition method, no pooling, no alternatives. Both recognize goodwill as the residual excess over fair value of net identifiable assets. Both expense acquisition costs. Both measure acquired assets and liabilities at acquisition date fair value. This convergence means that a practitioner trained on one standard can navigate the other with relative ease. But a few meaningful differences remain, and getting them wrong creates real errors, especially in cross-border transactions where entities under different reporting standards are combining. The most important difference is NCI measurement. Under US GAAP, NCI is always measured at fair value, the full goodwill method. Under IFRS 3, you have a choice, fair value or proportionate share of net identifiable assets. The IFRS choice produces lower NCI and lower goodwill. On goodwill impairment, US GAAP uses a one-step test comparing carrying amount to fair value of the reporting unit. IFRS uses a different framework based on cash-generating units. For contingent consideration, both standards require fair value recognition on day one, but the detailed classification criteria differ slightly. And the private company accounting alternative allowing goodwill amortization over up to 10 years exists only under US GAAP. IFRS does not offer this election. These are the errors that appear most frequently. Misclassifying a transaction, treating an asset acquisition as a business combination or vice versa, is foundational and produces cascading errors across goodwill, acquisition costs, and contingent consideration. Using the announcement date share price instead of the closing date price understates or overstates consideration. Failing to identify intangibles the acquiree never recorded, customer relationships, brand names, developed technology, misrepresents the balance sheet and overstates goodwill. Using acquiree book values instead of fair values for any asset class defeats the purpose of the acquisition method. And missing the 12-month measurement period deadline means adjustments that should be retrospective end up flowing through current period earnings instead. Auditors focus on several specific areas in a business combination. First, documentation of the business versus asset acquisition analysis, the concentration test work papers, and the three-element assessment. Second, independent valuation reports for all significant assets and intangibles, signed by qualified appraisers. Third, evidence of the acquisition date share price used for equity consideration. Fourth, a complete intangible identification analysis. Auditors will challenge any purchase price allocation where a disproportionate amount ends up in goodwill without a detailed analysis of why identified intangibles don't explain more value. And fifth, post-close tracking of provisional amounts and measurement period adjustments with clear documentation of what information was received and when. Business combination accounting requires clear role assignment and a systematic checklist. For acquisition identification, legal and finance must review all contracts to identify when control transfers and whether the acquired set qualifies as a business. The purchase price allocation is prepared by finance, typically with external valuation support for significant intangibles. A designated owner must track provisional amounts throughout the measurement period, month by month, and document what information arrives and when. Post-close, confirm that all fixed asset registers and intangible amortization schedules have been updated with the new fair value bases. At every period end during the measurement period, confirm the earn-out liability has been remeasured and that the ASC 805 disclosures are being drafted with the right level of detail. The disclosure requirements for a significant acquisition are extensive. Investors, analysts, and auditors all rely on them to understand the economics of the transaction. ASC 805 and IFRS 3 are closely aligned, but NCI measurement remains a meaningful difference in cross-border transactions. The most common errors in practice are avoidable. Document the classification analysis, use the right share price, identify all intangibles, and track the measurement period rigorously. Auditors expect documented valuations and a defensible intangible identification analysis. And the period-end checklist is your safety net. Business combinations have many moving parts that span months and years after closing. Thank you for completing this section and the full ASC 805 Business Combination series. The recap video will bring together the key concepts across all 7 sections. Thank you for watching. Subscribe for more training from PNJ Group.